a housing market correction takes years to play out, often 5 to 6 years to play out, because home sellers, even when the market has shifted down clearly, home sellers have this period of denial. And that period of denial will last like years for certain sellers before they cut the price. But incrementally, the market value gets adjusted down, 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 down. And then over 5 years, you find prices could be down 25%. So that's kind of the situation we're in right now in about half the US. In half the US, we are in the housing correction. And I think by the end of the year, half the US will be negative on price growth year over year.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Well, 2025 is here and the US housing market is still in an injured state. Will we start to see some healing this year, or may things take a turn for the worse? Today we've got the good fortune to be joined by housing analyst Nick Gerli, founder of Reventure Consulting and creator of the excellent Reventure app. Nick will walk us through his latest outlook on the US housing market and share a number of his charts with us. Spoiler alert, the weakness we've seen grow in previously hot markets like Florida and Texas are now starting to spread to key states like California. So what does that bode for the rest of 2025? Well, we'll hear it straight from the horse's mouth himself. Nick, thanks so much for joining us today.
Great being with you, Adam.
Hey, Nick, I'm very excited for this. You're always such a wonderful guy to talk to about the housing market. One, because you're smart, but two, because you bring a lot of data to the discussion. And today's discussion, I'm sure, will be no different. Before we get into all the nitty gritty of the details, just high level, what's your current assessment of the US housing market?
Yeah. So the housing market's still very overvalued. It's still in the biggest bubble of all time on a national basis. Prices are about 30% overvalued on a national basis. However, we are starting to see cracks form in many different areas of the housing market. We now officially have prices dropping in 4 different states on a year-over-year basis. And by the end of 2025, that's going to grow to 20 different states with price declines, according to my forecast, which ultimately will be good news if you're a prospective home buyer or investor out there. More affordability is coming to the housing market in 2025. So that's good news.
Okay, and I think that is the silver lining here that we want to, as we talk about this. I mean, so you and I have talked about the housing market for many years, and you have been predicting that prices will eventually correct. You've been warning about how overvalued the market has become, and we both have spent a lot of time talking about how it's hard not to imagine lower prices in the system in terms of the way that this thing corrects versus average incomes catching up to justify today's multiples. Is much more likely that we're going to see some cooling off and downward momentum in prices. And of course, if you're a homeowner, that's scary to hear, right? And certainly there will be pain in there, and probably pain for a lot of people. But there's a lot of pain that's being shouldered right now by the millions of aspiring homeowners who are either being forced to stretch to dangerous levels to get into a house, or who just can't get into a house. It's just housing has become unaffordable for them. And the fact that housing may start to become more affordable, that is a public good. And that is, hopefully the silver lining that folks can focus on if indeed we end up getting this correction that you think has actually, probably started. Real quick, so like, Nick, 2 things. If you can just give a quick overview as to what got us here, like what were the key drivers that got housing prices so inflated? And right before we turned on the camera here, we were talking about how, some of these things are actually still going on. There's some artificial support for the housing market, previous policies, whatnot, that are actually still going on, even though the market is sort of trying to correct at this point. So how did we get to this, what did you say, the biggest bubble of all time in the US housing market?
Yeah, it is the biggest bubble of all time, and that's because inflation-adjusted home prices are at levels that we've never seen before, even bigger than the 2006 bubble. So it's just very important to understand that if you're a prospective buyer, investor, or you're just someone who lives in your house and wants to understand the market. And so we're at an inflated level. And this inflated level has lasted longer than a lot of people have expected due to the government in the US providing all types of arbitrary support to the housing market. They printed $5 trillion during the pandemic through QE and fiscal stimulus. They banned foreclosures during the pandemic, and in some segments of the market, foreclosures are still banned. Right now, there's almost 400,000 seriously defaulted mortgages, which are blocked from foreclosure because of pandemic era legislation, which is still in place in 2025. And so, if someone is maybe fatigued by the housing market or skeptical that prices are going to drop, understand that the only reason they haven't yet is because the government provided all this artificial support. However, things are starting to change. And the first thing I want to show you guys, if you wouldn't mind, I'm just going to show a graph, Adam, is the level of inventory on the housing market. We now have way more supply than we used to. So right now, we're up to 892,000 listings across the US housing market for resale homes. That's up 29% year over year. So the big thing to understand looking at this graph is that there's no longer that supply shortage that everyone was talking about. During the pandemic, 2021, 2022, we only had 400,000 homes on the market. That's why prices jumped so much as well. It wasn't just the government intervention, it was because we actually did have an acute shortage during the pandemic. However, that shortage is now no longer there. We're back to pre-pandemic inventory on the resale market. And this is important for you guys to understand out there because in certain cities and states, we now have way more inventory than we used to. So on a national basis, we're back to close to pre-pandemic inventory, but in certain states like Texas, Florida, Colorado, Utah, Arizona, we now have the highest level of housing supplies that we've seen since the end of the last housing crash in 2010, 2011, 2012. So just think about that for a second. We're told this narrative of the housing shortage, yet in a lot of key boomtown markets, we now have the most supply that we've seen in over a decade. And that's starting to drive down price growth and push prices into negative territory.
So two important things there. One, just want to underscore, yeah, we've been hearing for a long time this narrative of housing prices really can't come down because we've got this chronic housing inventory shortage. You're saying, at least in the previous boomtown markets, and I'm guessing in a growing number of markets, not the case anymore. So if you are guiding your decision making based upon that narrative, you might want to reconsider, right? You might realize that reality has changed. Second, Nick, is corrections when you're at one extreme and then you start mean reverting the other direction. They don't tend just to stop on the mean once they've gotten back to it. They tend to overshoot. So even in the markets that you just mentioned, where inventory is now surged back to levels that it was back, I think you said after the GFC. Do you expect those to continue rising from here, or are they starting to equilibrate?
The inventory levels are still rising and still rising fast. In the case of Florida, which has almost 180,000 homes on the market, inventory is up still 30% year over year. I mean, that's a massive gain on a housing supply level that was already elevated. So in Florida, which is kind of the first market, let's say, to really be in a downturn, the supply is still stacking up and the sellers are starting to get desperate down here. I live in St. Petersburg, Florida. I cover the housing market down here. I look at a lot of listings and film videos. I'm seeing $50,000 price cuts. I'm seeing $100,000 price cuts. So something mentally has also started shifting among many sellers over the last 3 months, where I think a lot of them were stubborn. Some of them still are stubborn, but more and more are realizing that the party's over. And to actually sell your house, you need to reduce the price by a lot from what you think it was worth. And we're starting to see that price action in Florida. We have certain markets in Florida that are down more than 8% year over year in terms of typical home value. Almost every large county in Florida is declining year over year in terms of home value. So we are really actually seeing this play out in some key markets.
So let me ask you this. So we've got, some of these markets are pretty hot, but let's take Florida, right? First, COVID happened, and everybody, all of a sudden could work from home, right? And so a lot of people were like, "Look, much nicer to, work from home down in Florida than it is, say, up in the cold Northeast, right?" So a lot of people moved into Florida. A lot of people fled my state of California for Texas and for Florida and other, much lower cost states, or at the very least low to no income tax relative to California's high taxes. So, uh, there was a population inflow. We also had some pretty bad storms in Florida where people had said, oh, you know what, that's taking inventory off the market, right? So I think there's a narrative that folks may have had that said, oh, well, prices should go up because you've got population inflow and you've got, destroyed inventory from the storms. I want to get your answer on that as to why is that not playing out that way? Why instead are we seeing prices decline? But let me connect one more potential dot, which is I saw a recent note of yours, Nick, on X, saying that California is starting to crack, and you were noting, I think, the rise of inventory in LA. LA just had a bunch of fires. So everybody here thought, oh gosh, housing is going to get pushed up in LA because we have this, all these homes that just got burned. So why are these, you know, uh, what do you want to call them? External factors that
Yeah,
everybody
these
just sort of,
narratives, like these external
yeah.
factors and the narratives that result, why are they not resulting in lower inventory? So easy answers, two things. Number one is lack of affordability. So home prices, that big bubble I was telling you guys about earlier, combined with mortgage rates at 7%, means that home buyers can literally not afford to buy houses. They can't afford to buy houses. The demand is constrained. We actually have the lowest home sale activity that we've seen in 20 years on the housing market right now, and that's not recovering. So the demand is super constrained due to the lack of affordability. So demand's just pressed down and won't recover until affordability returns. So there's no demand. On the supply side, for a while, we did have restricted supply. We had the mortgage rate lock-in effect. We had maybe the economy doing better in 2021 and 2022. But now, fast forward to 2025, more and more homeowners have actually refinanced, have a 6 or 7% mortgage. More and more homeowners are feeling the financial and fiscal stresses of 3 years of inflation and the economy turning down. So that's now causing more homeowners to be forced to sell. So we're seeing more and more new listings come on the market. In California, the new listings are hitting the highest level that we've seen in 5 years. And new listings just means sellers now listing their home. And so when you have, let's say, a 10 to 20% increase in new listings and the demand is down, that's going to cause inventory to spike. And those factors will crush and outweigh any smaller narrative that's being developed about, fires causing some housing stock to be off the market or hurricanes causing some housing stock to be off the market. And I just want to show your viewers, Adam, the data so they can really understand what's going on because it's actually kind of shocking. And actually, one thing I want to show you is I want to touch upon a point that you were mentioning. You're mentioning migration. Talk about people moving during the pandemic. This is the other trend to pay attention to. In the case of Florida, this data is on Reventure app. It measures the domestic migration into Florida. We had plus 64,000 net people, net Americans move into Florida in 2024. Is that good or bad? Well, look at the historical chart. Back in 2022, we had 314,000 net people move to Florida. That was the influx during the pandemic you were describing. 2021, 2022, we literally had a record number of people moving to Florida. 2024, we had the fifth worst
Mm.
inbound migration into Florida in 35 years, according to data from the US Census Bureau. So if you're talking about a pandemic boom state like Florida and you see this domestic migration plummet, well, obviously the housing market's going to suffer. Obviously inventory is going to go up and home prices are going to go down because you no longer have this influx of wealthy people from California and New York paying over asking price in cash. When you see this migration figure go down, that means all of a sudden the local home buyer in Florida now needs to support the market. The trouble with that is that the local home buyer in Florida needs to spend 40% of their gross median household income on mortgage payments and taxes in order to afford to buy a house, which just means that the local population can't afford to buy a house. The last time we saw this lack of affordability in Florida was, you guessed it, '07, before the big crash. And I want you to look at this, Adam. And the long-term average in Florida is a mortgage payment to income ratio of 27% over 20 years. It's 40% right now. As long as this payment ratio is above the long-term norm, we're not going to see demand return. And this is not just Florida. This is like in a lot of states. Talk about California. In California, the typical household would need to spend 62% of their median income in order to buy a house. which obviously means the vast majority of households in California are not even coming close to being able to afford to qualify for a mortgage. Once again, you could see the last time California saw this lack of affordability was 2007 before the big crash. And what's starting to change the scenario now is inventory. So in California, there's 58,000 homes on the market as of March 2025. Look at this jump from last year. Last year we were at 38,000 homes. Now we're at 58,000 homes. So that's the highest level of inventory since 2019. It's now well above the long-term average. And this is now causing home values to actually drop in California. This amazed me. So year over year, prices in California are up 2.9%. And we'll get to some other states soon, but I just want to show your viewers this. Prices are up 2.9% year over year in California. But on a month over month basis, seasonally adjusted, they're going down now. So month
Hmm.
over month, seasonally adjusted prices are dropping in California, Arizona, Colorado, Texas, Georgia, Florida, interestingly, Vermont, and even in Hawaii, prices are now starting to drop on a month over month basis. So we're actually already seeing these price declines happen. This is not like speculative or theoretical anymore. The question is just how much are the values going to drop, and are we going to continue to see, more and more inventory hit the market?
Okay. So first off, I just wanted, you mentioned it super briefly, but all that data that you were just showing us, Nick, were coming from your Reventure app, right? So if people want to see that data for themselves, dig into it, play around more, they can do all that on your app, right?
Yeah, that's the website I created to help home buyers and investors access this data for themselves.
Okay, great. And at the end of this interview, I'll let you tell everybody where to go find it and what they can get out of it. But it's a great, great tool, and I'm sure we're going to use it more throughout this conversation. So, showing those states starting to turn blue, and I know it's on a month to month, sorry, yeah, monthly seasonal adjusted basis. Um, but I'm almost sort of reminded of COVID as we were sort of, starting to track contagion, right? That's sort of what it looks like, this contagion of lower prices, rising inventory. It's starting to pass through here. I think that's why you said California is starting to crack because it now is down on a monthly basis. Um, so uh, you basically just asked the question I'm going to throw right back at you, which is, okay, so the big question here is, where does it go from here? Do things pick up from here? How low does it go? You showed some of the states where you showed how far uh, the percent of income needed to afford the
Yeah.
median price is above long-term means. Do you expect it to get down to the mean before this is over? Do you expect it to overshoot the mean on the way down?
It's a great question. I do expect it to get back to that long-term norm because the housing market actually over the long run is fairly predictable. Like if we just zoom out for a second here and just think about the housing market over decades or maybe even over 50 years, home prices revert to income levels and rent levels. So if you want to ask yourself, like, how do you actually figure out if it's a good time to buy a house and if the value is going to go up or down into the future? And what's the fundamental value of a house that you're looking at buying or the house you live in? Look at the rent that you could rent that house out for and look at the local incomes. Because those are the two factors which ultimately drive home prices in the long run. And so the reason that we're in a bubble is because home price growth overshot income and rent growth for the last actually 5 to 7 years. So when home price growth overshoots income and rent growth, you end up in a situation where all of a sudden home buyers cannot afford the houses, and then the mortgage payments as a percentage of their income are crazy. And a lot of people try to say, oh, it's because the mortgage rates are at 7%. The issue isn't mortgage rates. A 6.5 to 7% mortgage rate is abundantly normal for the housing market if you look back 50 to 100 years. There's nothing strange about today's mortgage rates. I think they will drop a little bit, but that's not what's driving the lack of affordability. What's driving the lack of affordability is the fact that prices are too high. Prices went up way more than income and rent. And an interesting thing to think about is that the income levels determine how home buyers can afford homes. The rent levels determine how investors can afford homes.
Right.
And one piece of the market that further convinces me that we are going to see more of a downturn in the future is what's going on with real estate investors. Because there's a lot of misinformation about this. Like there's still people talking about like how investors are buying all the homes and BlackRock is buying all the homes. That is not happening anymore. In fact, the exact opposite is occurring. These investors are selling houses. And in some markets, these investor purchases have completely fallen off the table. And you have to ask yourself, like, if you're a potential buyer or you want to understand like where prices are heading in your market, take a look at what the investors are doing. Because it's a key. The investors are more, generally smart money. On a national basis, nominal investor purchases, according to Redfin, peaked in 2021. They're now down more than 50% from their peak. The number of investors buying houses is down 50% from their peak. How many people, watching this video actually knew that? If you don't pay attention to the data, you're not going to know that, but it's very instructive about what's going to happen. Like, take a look at Atlanta. In Atlanta, the investor purchases in the third quarter of 2021 were at
Oh,
13,000.
wow.
They're now at 3,000. They're literally like at the same level they were in 2013 at the end of the last housing crash.
Right. That's
Investors,
about a 75% drop. Yeah.
75% drop. Investors, they've abandoned Atlanta's housing market. They are no longer buying in Atlanta. In fact, they're selling. Other markets are similar. Look at Orlando. In Orlando, we had, according to Redfin, 4,200 investor purchases in second quarter of 2022. That's now down to 1,483. So, what is that at? It's like another 65 or 70% drop. And look at how similar this looks to what happened in the last downturn. Investor purchases peaked in the last bubble in late '05 and then just kept going down. And they kept going down even while prices kept going up. Prices kept going up in '06. Investor purchases went down. And then it was around here, early '08, when prices started dropping. By then, investors were already well out of the market.
Right.
So
So
this
they're sort of the
investor,
smart money here, and to a certain extent.
that's right. So this investor purchase data is kind of the leading indicator of sorts. Another market to look at would be Vegas. Look at this. In Vegas, in the second quarter of 2022, 4,100 investor purchases. I mean, this looks identical to Orlando almost. It's kind of funny. Vegas and Orlando, different sides of the country, but they're behaving in a similar way in terms of investors abandoning these markets. Another market where investors are abandoning is Phoenix. Look at Phoenix. Phoenix had 9,300 investor purchases in the third quarter of 2021. Now that's down to 2,700. That's literally the lowest level since 2012.
Wow.
And wow, look, same exact action happened in Phoenix, like in the last bubble leading into the last crash. And so, yeah, people want to spin whatever narrative they can about why home prices won't drop. Oh, the investors will just buy them. Oh, the mortgage rate lock-in effect. When you actually look at the data, it's becoming so clear that the housing correction is happening. Like, it's not just about to happen, it's happening.
Happening.
But home prices tend to go down slowly. It's not like the stock market. It's not like Nvidia that will go down 20% in a day or 10% in a day. A housing market correction takes years to play out, often 5 to 6 years to play out, because home sellers, even when the market has shifted down clearly, home sellers have this period of denial. And that period of denial will last like years for certain sellers before they cut the price. But incrementally, the market value gets adjusted down, 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 down. And then over 5 years, you find prices could be down 25%. So that's kind of the situation we're in right now in about half the US. In half the US, we are in the housing correction. And I think by the end of the year, half the US will be negative on price growth year over year.
All right. Okay. So you heard it here, folks. Half the U.S. will have negative price growth by the end of the year. Now, Nick, I think when I talked to you last, which was a couple of months ago, you were unsure, I think, whether nationally home prices on average were going to end the year lower. Sounds like you're a bit more confident now. Is that fair to say?
Yeah, my original forecast for national price growth in 2025 was 0.9%. So back in December, we at Reventure, we were forecasting around 1% price growth on a national basis. We have not done an official revision of that yet, but I think if we did, yeah, we'd probably be close to zero now. Um, I don't know if we'd be less than zero on a national basis, but I can tell you, I'm looking at my sheet in front of me. We have prices going down in about 20 different areas now over the next year. And it's due to the fundamental data we're looking at. Inventory, price cuts, days on market are just
Mhm.
skyrocketing in all these different states and cities. And yeah, so I feel very confident that in probably 20 to 25 states, prices will be negative by the end of the year.
Okay, so I'm curious if that's the case, and you're thinking maybe, you know, we'll be flat, maybe a tiny bit negative, who knows, but pretty much flat. Does that mean that the rest of the country is still growing enough to keep things flat?
Yeah, it's
And
great,
and
great
and, and
question.
what's driving that? Is it lack
Yeah,
of
so
inventory in those markets, or what's driving that?
yeah, so we have a really bifurcated market right now. So in the South, in the Mountain West, states like Florida, Texas, Tennessee, Colorado, Utah, Arizona, Nevada, right? Inventory is way up. Price cuts are way up. Values are starting to trend down or will trend down soon. And then we're even seeing that in California, starting to. But in the Northeast and Midwest, this is what's crazy. There is still an acute housing shortage in the Northeast and Midwest US. And in fact, in the Midwest, inventory is still down 43% from pre-pandemic. In the Northeast, it's down over 50%. And so if you have inventory down 40 to 50%, that means prices are still going to go up because there is actually a shortage. So in states like New Jersey, Connecticut, Illinois, West Virginia, these markets are still going up and going up by a lot. There's still bidding wars in these states because there's no inventory. And let me show you if you don't mind, because I think a lot of people, again, it like runs counter to the actual narrative, right? So, the actual narrative is telling you that, oh, all the people are moving to the South, so prices should go up in the South. But no, we're seeing values drop now on a month over month basis in the South and Mountain West. But where are values going up the most? Ohio, West Virginia, Kentucky. Values in Kentucky went up 1% month over month from January to February. These areas in red are where prices are going up the most on a month over month. And if you look at it kind of in a chart form, Kentucky, Mississippi, West Virginia, Wyoming, Ohio, Iowa, Indiana, North Dakota, Wisconsin, Illinois.
Yeah, it's Rust
Those are
Belt.
the top housing markets in America right now. Take a look at that list, everyone, because this housing market has changed. It is no longer the conventional boomtown markets that are doing the best. It's the Deep South and the Rust Belt Midwest and parts of the Northeast that are now doing the best. And
So
I think,
it's so important to see this because it just, first off, it just is what it is, right? Like narratives
right.
be damned. This is just what's happening here. What do you attribute this to, Nick? Are people flooding into these markets? Is it revitalization of American manufacturing, that the
Yeah, very
administration is
interesting you bring
claiming?
that
Like,
up. I,
yeah,
I think I think there is something going on where there is some type of migration shift to some of these markets. Now, like interestingly, Ohio lost people in 2024. Illinois lost a lot of people in 2024. But here's the thing on the migration. Illinois lost 143,000 in 2022, right? But then it only lost 56,000 in 2024. So actually in 2024, even though Illinois lost people, it was its best year for migration since 2020. Oh, sorry, since 2010.
right.
So,
Although still negative. I mean, one could say, well, the people that were going to leave left, right? And therefore, you'd
right.
expect it to decrease. But
So, right. But so like migration's still negative, but they just don't build any houses. So like in Illinois, there's 16,000 building permits over the last year. Like, look at this. In the last bubble in '06, there was 70,000 building permits in Illinois. That's dropped all the way down to 16,000.
wow.
So they just
And
don't
and
build homes.
and why is that? Is it because of just overburdensome regulation, or is
Yeah.
it just lack of space or lack of demand?
Yeah. And I'm going to answer that question. But before I do, I just want to show a comparison. So that's Illinois, right?
Okay.
And let's look at another market like New Jersey. Actually, New Jersey, it's been pretty consistent, but this is a fairly low level. I think I'm like a lot of Midwest markets, like Ohio would probably be one. Similar thing, where like they were building 53,000 homes in '06, that's down to 28,000 homes per year. But you compare that to Texas. Look at that. The building permits in Texas just rocketed higher.
Right.
The building permits in Florida just rocketed close to where they were in the previous bubble.
Yeah.
So I think what's going on is like, yeah, builders have kind of abandoned these Midwest and Northeast markets. They're just not building there. Like D.R. Horton, Lennar, they're just not going to these markets. They've even kind of abandoned California as well. In California, the building permits were at 200,000 in '05. They're at 100,000 today. So the building permits are half the levels of the previous bubble.
Hmm.
It's almost like the builders have pulled out of these markets and then just gone into like Texas, Florida, Georgia, Tennessee. You know, you could see in Tennessee, building permits are near a record high. You could see in Colorado, building permits were at a record high in 2022. So the builders have kind of abandoned the Midwest, the Rust Belt, the Northeast, moved down to the South. Now, why is that? I think building regulation is one, right? In California, and New Jersey, and probably close to Chicago, it's probably hard to get a house permitted. I think the migration levels are another. I think the builders kind of looked at the migration. They just said, we're going to go south.
Right.
Um, Combination of factors.
Right.
And
Probably hard in the Rust Belt to have recovered. They had a harder time recovering from the GFC.
that's right. That's
Yeah.
right. Right. Whereas the South recovered faster from the last recession, right? By 2013, the South was growing again. So the builders were just all went south. But what ended up happening is that the units that should have been built in the Midwest and Northeast all got built in the South by even more,
Hmm.
right? And that's explaining the current situation
That's the right way to think of it. Yeah. Okay.
where the supply, yeah, where
Yeah.
the
There's going to
supply
be a
levels
certain
in the
number of
South,
houses built, and the South just sucked them away. Yeah. Got it.
yeah, and you combine that overbuilding in the South with the investor behavior that we saw during the pandemic, and that's how you get the situation we're seeing now, where a lot of investors bought in also 2021, 2022. A lot of investors bought from builders in states like Florida, Texas, Tennessee, and Nevada. And now these investors can't rent out their homes. The rents are dropping, the property taxes are going up, and they're just now having to sell. Like there's a lot of investors here in Florida. I feel like sometimes half the listings, I look at the history, it used to be a rental, and now
Yeah.
it's listed on the market.
So
So
I've been trying not to pat ourselves on the back too hard here, Nick, so far in this conversation. I should be doing it more for you because you've obviously been way out in front of this and been banging this drum for a long time. But a lot of what's going on is what you and I have predicted in our previous discussions. And, you know, I think we've gotten the direction right. We maybe didn't get the timing right, but you gave a good explanation for that earlier on, right? As there was a lot of things that were being done um, to try to fight against this, right? A lot of those government programs that you were talking about, uh, denying foreclosure or keeping
yeah,
foreclosures from
four
happening.
hundred thousand foreclosures are still being blocked.
Yeah,
I mean, that's
still.
like this, right? Like that's like all the data I'm showing you. There's still 400,000 foreclosures being blocked right now by pandemic era foreclosure bans. Like, we don't know. Apparently, there's now the Congress and Senate has told the Trump administration that they should repeal those foreclosure bans. We'll see what happens. But yeah, so there's still things happening in the market today trying to prevent it from going to a downturn, but eventually it's going to happen, right? I mean, it's just the longer the lack of affordability is there, the more that things start to normalize, the more that homeowners are pinched, the more that inventory is going to come on the market. And actually, I mean, if you don't mind, Adam, I want to actually put some numbers to what I'm talking about here. Like, where are the states, where are the cities where prices are going to drop the most over the next 12 months in actual percentage terms?
I think that's probably what folks care the most about. So let's
Yeah.
get there. Why don't you start
Yeah.
pulling that up? Let me just finish the point I was making, which is that amongst some of the things you and I just thought inevitably would have to happen would be that once the market started to turn, especially in these boom towns where most of the investors were buying up properties in the past boom cycle, um, that for the investor, the house isn't an essential. It's not essential. It's not the roof over their head. It's really just a line item in an Excel spreadsheet. And once it got to the point where, hey, wait a minute, this thing isn't penciling out for us anymore, well, we'll just sell it, right? And in markets like where you are, Nick, right, where there were a lot of high concentration of those investors, I'm not surprised that you're saying, hey, it seems like every other house here has was a rental. Like this is what we predicted.
I totally agree, Adam. It is what we predicted. And a lot of people, it's like, oh, it's never going to happen, right? And, oh, it hasn't happened yet. Some people still might say, oh, home prices are up 2.5% on a national basis year over year. But yeah, when you look at the metrics, when you look at the trends, it's the housing market's really starting to correct in certain pockets of this country. And the way that I think about it, and I want to kind of share with your viewers kind of how fundamental the analysis we do at Reventure is, right? Like we're not guessing here in terms of our forecasts and where we think prices are dropping. We have a home price forecast score for every state, as well as for every metro, county, and zip code in America, which,
God,
at
that's
some point you guys
amazing.
should check it out. Yeah, we have it, and it's like an objective forecast. We calculate it the same way in every market. And the states in blue are the ones where we think the prices are going to drop the most. And the score is from 0 to 100. So if I just pull up Colorado, you can see in Colorado, we now have a 37 out of 100, which indicates prices down. And the reason why is because we're looking at trends in appreciation, days on market, mortgage rates, inventory, and price cuts. And those trends are now indicating that prices are going to drop. Now, you can see the historical trend, like in 2022, we still had this as a seller's market, right? Score of 71, which indicates double-digit price growth. But then we slowed to a 45, 46 out of 100 the last 2 years, which is kind of like flat to maybe slightly down. But then take a look at this big drop now year over year. This is really the concern. Now, a 37 out of 100 corresponds to about -4 to -5% 1 year price forecast if you look at this conversion chart. So
Mm,
the lower the score is, the more that we're predicting that prices are going to drop. The higher the score is, the more that we're predicting prices are going to go up. 50 is about the baseline, which corresponds to 2% appreciation. That's basically like what your property taxes and insurance go up by. You need the prices to go up 2% a year just to even stay afloat. Um, and if you can, look on this map, we have forecasts now going down in about 20 different states
yeah,
across
look
the
at that.
US. We still have them going up though here in the Northeast and Midwest, but in about 20 different states we have them going down.
Okay. And
And
Nick, was I right? Like, if we were to look at that map like 6 months ago, would it have a lot less blue? Like,
yeah, so
are
I'm
you
glad
starting
you
to see
asked
a
that.
contagion?
Let me show you. So let me show you what this map looked like a year ago in 2024. So this is a forward forecast, right? So a year ago looked much different, way
Yep.
more red, right? Indicating way more stability and upward price movement. So like in California, we were at a 53 out of 100 a year ago, right? Indicating we expected prices to go up in California. The only markets that we really had downward forecasts were Utah, Texas, Florida, right? Like a year ago, that was our forecast. Now, if you look, how did prices then trend over the next year? You could see the price growth, actual price growth, mirrors what the forecast was a year ago. So, this is why I'm really excited actually about sharing this with your viewers, is because, we've developed a score that's proven to be very predictive of where prices are going to go in the future. We compared our score to Zillow's forecast. Our forecast is 2 times better than Zillow's at predicting the future direction of prices. And so, with that, where are we projecting prices to drop the most this year? You can see we have the score here, the Reventure score, 33 out of 100 for DC. That corresponds to -5.8% projected appreciation over the next 12 months. So DC is the housing market that we have the lowest forecast on.
All right. And
Inventory
sorry,
there is way up.
yeah, I got to interrupt you here. Like, what are the inputs to this? Because somebody might say, oh, yeah, DC is going to get whacked because of Doge and all the government jobs that are getting slashed. I don't get a sense that you're taking like a macro
No,
outlook and baking it in here. You're getting that from specific data sets that you're looking at, correct?
correct. There's nothing qualitative here. So the reason our forecast in DC is down is because of inventory. There's now 2,500 homes for sale in the District of Columbia in March 2025. The long-term average is 1,500. So this is the other thing I would say. Whatever qualitative narrative you want to put out there about the housing market, mortgage rates, layoffs, government jobs, Doge, migration shifts, you can say whatever you want. It has to show up in the data to actually be meaningful. So, it is showing up in the data in DC. Lots of homes for sale. We also have days on market in Washington, D.C. of 43 days, which is well above the long-term average for March of 35 days. So it's showing up in the data in DC. And that's why our forecast is negative and heavily negative. Now we have Florida at number 2, 35 out of 100, minus 4.9% growth over the next year. Texas at number 3, Arizona at number 4, Colorado at number 5. These markets we all think statewide basis 4 to 6% year-over-year declines. Now, if you go into certain metros in these markets, we have even bigger downward forecasts for certain markets. Like in Colorado, it's really interesting. The western half of the state is actually still strong. So if we look at the home price forecast in Colorado, we can actually see like at least stable prices, Durango, Edwards, Grand Junction. But then if you go to Denver, oh my goodness, we have a huge downward forecast in Denver where we think prices are going to drop 9% in Denver.
Wow.
So there's also a lot of metro level variation. And I would also say, folks, like there's a lot of zip code level, neighborhood level variation in these forecasts. Like if we look at Dallas, we can see we have certain areas to the north of Dallas, Highland Park, really wealthy area. We still think prices are going to be stable or up probably 4% over the next year in Highland Park. But if you go west to Irving, prices are going to drop because there's a lot of supply. Sellers are cutting the price. So this is the other thing to think about. It's not just kind of shifting from a narrative-based thinking into data-based thinking. It's also zooming even further on your city and zip code to actually see what the local trends are in your market.
Yeah, I can see this being so useful to so many different people, Nick. Obviously, if you're a housing investor, great way to be looking at where the puck is headed and, checking out markets that maybe you have on your hit list, but hey, if the price is going to keep going down, let me wait and get in at lower values. Obviously, probably most importantly, if you're an aspiring home buyer, this will tell you if the areas you're looking to buy in are, if time is on your side or not. And if you're a seller who may have some motivation to sell, this will give you a sense, do you have time to hang in there? Or gosh, if it looks like this thing's going to go down over the next year, maybe you're better off getting out sooner rather than later. Again, we'll talk about at the end about how folks can get a hold of this tool, but it's so exciting to see this because I remember when you launched this tool, and every time that you come on and we talk, it seems that it gets additional granularity, additional intelligence, like the scores that you've just been walking us through. So
And let me just say
kudos
one more
for
thing
building such a
about that,
great
if you don't
resource.
mind. Like, I don't know if you ever watched the movie Moneyball or read the book Moneyball.
Absolutely.
It's
Yeah.
about the Oakland Athletics and Billy Beane
Michael
reinventing
Lewis. Yeah.
how baseball, people analyze baseball. And, ultimately I'm trying to do that for the housing market here because the housing market is a $50 trillion asset class almost. $50 trillion is the aggregate value of homes across America. And somehow for a $50 trillion asset class, 99% of people don't understand how to even evaluate the market, right? And I'm not even saying, you can be perfect at it, right? No projection's perfect. But for an asset class that's so big and where the value of someone's house is so important to their personal net worth, their personal feeling of security and stability, it's imperative to at least have an idea, right, of where the market is trending into the future that's based off data and not based off just whatever narrative your realtor is trying to tell you.
Right. Well, and so a very important part on the macro, huge market, not great intelligence, but on the micro level, for most people, this is going to be the biggest financial decision they make in their lifetimes, right? And the fact that in many cases people are making it so blind, and I'll tell you, out in California where I live, um, the dominant narrative here is you just have to buy in, or else you're going to get priced out forever, which for the past 20 years plus, to be honest, it probably has been largely the right narrative. But if you're a younger family and you are thinking of buying a home and everybody's telling you, hey, I know it feels like you've got to just stretch yourself to crazy levels that feel risky to you, but hey, housing only goes up here, and if you don't buy now, you're going to be priced out the rest of your life. Well, if your system says, hey, look, California may actually have a multi-year progression of down prices, those people could just be, walking into a buzzsaw if they're just following the current narrative.
Yeah, I think it's a great point because ultimately, it's funny. I actually polled my audience and I asked them, what's the real value of buying a house? Like, why do you want to buy a house? Or what's the value of real estate? The number one thing people said was actually buying a house is good for raising a family. The number two thing they said was buying a house is good for stability and security. That was like 60% of the responses. Almost no one
Hmm.
said buying a house because I want to achieve long-term financial prosperity. And so I think home buyers in this market have actually become a lot more intelligent. I think 15, 20 years ago, a lot of people were buying into whatever narrative was being sold, about how you have to buy. I think buyers are much more intelligent this time around. It's showing up in the home sales and mortgage application data. I think a lot of people now know that taking on a massive mortgage that you barely can afford to pay is not necessarily the best idea. And so, people, if you're a prospective buyer out there, you got to do the math on that. And one of my favorite comparisons actually, there's a lot of different ways to look at the market, right? But in terms of fundamentals, so what we've been talking about so far, Adam, is like forecast where a price is heading the next 12 months.
Right.
But there's also another question to ask is financially speaking, is it a good time to buy? Am I overpaying? Right? I know a lot of people care about that. If I buy today in this market, am I overpaying and will I lose money? Right? And to answer that question, you have to dig deeper into the fundamentals. We have a metric called overvaluation rate on Reventure app, which shows you how overvalued prices are compared to the long-term norm. But another one I love is the buy versus rent comparison. How much it costs to buy in terms of your monthly payment versus how much it costs to rent a similar house.
Hmm.
And the one metric that's just shocking is how much more expensive it is to buy in this market than to rent. And in California, that same house will often cost 2 times as much money to buy with a mortgage than it will to rent. So if that's the case, the thesis pushing someone into buying is very suspect because you're then going to take out a mortgage at 7% and buy a house for 800 or a million, 800,000 or $1 million, and your monthly payment is going to double. I mean, I know you live in California, Adam. I don't know if that's something you see out there, that buy versus rent
Oh,
differential, but I think
all the
a
time. Although,
prospective
although where I
buyer.
am, you can't buy a place for 800,000. It started 1.5 million easy.
Yeah. Yeah, let me actually just pull this up. We're looking at the Bay Area here in California, and we can actually look at this nationally because I think this is an important data point to understand if you're a buyer and why this market will continue to drop. Is the buy versus rent differential. So this is another data point we have on Reventure app, and it compares the typical house payment. Technically, it's to the typical apartment rent. We're probably going to want to adjust that soon to be the single family house rent, but it's still a pretty good gauge. And in markets like look at Salt Lake City, it costs 111% more expensive to buy than it is to rent. So if that's the case, why would anyone buy? And you
Hmm.
could see that that wasn't the case before. In Salt Lake City, it was like even or a little more expensive to buy. Now it's way more expensive to buy. So why would a first-time buyer plunge into the market? You're in the Bay Area. Like, let's look at San Francisco. In San Francisco, it's 115% more expensive to buy than it is to rent. Typical monthly mortgage payment of 7,600 a month. Monthly apartment rent is 3,000. You know, so as long as that cavernous gulf exists, buyer demand will remain low. I also want to address another point you said. People saying prices never go down in California. That's not true. In the last downturn from '07 to 2012, prices in San Francisco dropped 32%. Prices in Santa Rosa went down 43%. Prices in Sacramento went down 49%. Prices in Stockton went down 63%. Prices in LA went down 38%. You can see at a statewide level, California corrected 42% in the last housing crash. That was the fourth worst downturn of any state. Only Florida, Arizona, and Nevada were worse. So, this is another thing. We can talk about where prices are heading in the future, but it's also important to understand the history of your local housing market. If a local realtor is trying to tell you to buy a house because prices only go up, and then you look up the data and you find out that in your zip code prices went down 50% only 15 years ago, That's useful information to inform your decision on whether it's the right time to buy.
Yeah, absolutely. And again, kudos for building such a useful tool to give people that intelligence to make the more informed decision. Um, a word that you and I have yet to use in this conversation, Nick, is the word recession. And I know that your tool is really looking at existing data, right? And so it's extrapolating from the data that is happening in real time right now. It doesn't factor in, oh, has the risk of recession gone up or down this week, given macro development A, B, or C. I'll just say objectively, more of the people that I interview on this channel are becoming increasingly confident, or think it's increasingly likely that we will enter recession in the next 12 months, probably before the end of the year. Now, they could be wrong. They've been wrong before. But if they're right, what impact do you expect that to have, if any, to your forecast there at Reventure?
Yeah. So a recession would likely mean more layoffs, would likely mean more financial strain on homeowners and more mortgage defaults. So those things would lead to more new listings and more distressed sales on the housing market, which would increase inventory and then increase the price cut rate and increase how long homes are sitting and thus lower our forecast, right? So that's kind of the mechanism of how a recession qualitatively would filter through to a lower price forecast. And yeah, so I think that would cause prices to drop by more into the future. I do think, interestingly, you can also use this data to understand if your economy is entering a downturn. I was just looking at Silicon Valley today, right? Silicon Valley is a very interesting place, right? Because you have the AI boom,
Hmm.
and people are like wondering, is the AI boom real? Is the AI boom a bubble? And I was looking at the Silicon Valley housing market, and something really interesting popped up. And if you don't mind, I know this is a little different maybe than how you wanted me to answer this question,
No, it's
but
fine.
like, I want to show you all something, and it caught my eye. Housing inventory in real time is kind of a recession indicator for a local area, right? If housing inventory skyrockets, why is housing inventory skyrocketing? Well, there's less buyer demand, more sellers. This is Santa Clara County, where Nvidia is, Google, all these tech companies. A year ago, there was 800 homes on the market for sale. Now there's almost 1,400.
Wow.
So why did we have that big surge in inventory in Santa Clara County, the second highest level for March going back 9 years? Then you look on a month over month basis, price growth is now dropping. Now, the typical home is 1.7 million. So most people will never be able to afford a home in Santa Clara County, but you can see month over month, the prices are dropping, the inventory is going up. So, just to help answer the question, like, is a recession happening? Is the AI bubble real? Like, are we going to see stock market corrections? I don't know the answer to that, but I do know that we are seeing alarming spikes in inventory in a lot of these markets. Look at Alameda County, or is it Alameda?
Alameda.
Alameda. The people always get me on the pronunciation of some of these areas in California. We went from 950 homes for sale to 1,600 homes for sale March to March 2024 to 2025. That's the highest level of inventory in Alameda County on record, going back almost a decade. So when you see these type of inventory surges, it's telling you two things. Yes, the local housing market is slowing, but it's also telling you maybe, yeah, like maybe there is something going on in the local economy.
Ah, that's so interesting. And as a Bay Area resident, I'm gonna have to play around a little bit more with those Silicon Valley stats there, because that's actually just super interesting to see what that may be foretelling about what may be underway here. But
If you don't mind, Adam, can I just say
yeah,
one more thing?
yeah.
But to maybe get to I think what you were kind of trying to guiding me to, like if we do have a recession, like I do think the prices are going to drop by more, but it's going to again be market by market. So the more inventory there is, right, the more then that market becomes at risk during a recession because it's already flashing warning signals with the supply. Additionally, the more overvalued home prices are compared to long-term norms, the more risk there is. So if I wanted to kind of show your viewers, what would be the states that in a recession would have the biggest downward trajectory? So I would look at how overvalued prices are. So prices are overvalued in almost every state, except for Louisiana and North Dakota, where they're undervalued. In every other state, they're overvalued, and that's because prices went up more than incomes. But if I were to filter out and say, let's only look at the states where prices are 15% overvalued or more. Okay, we just kicked out like a bunch of states in the Northeast, Midwest, Deep South that I don't think in general are going to have much of a housing correction. But if we were to add to this, let's look at states where the inventory is at least 30% above the long-term norm. Maybe do 20. So these would be states where prices are overvalued and inventory is now above the long-term norm. These would be the places most at risk, just in general, if a recession hits, because they don't have the fundamentals supporting the market. And as you can see, it's Southeast, Texas and Oklahoma. Interestingly, Nebraska snuck in there. And
Yeah.
then Mountain West into Washington and California. You know,
Yeah.
those are like these are the markets where there's the most risk from a real estate standpoint. Just in general, both in the short term and the long term.
I got to ask this. I think the answer is no, but uh, just the speculator in me. If Idaho were a stock, and I'm guessing it's probably mostly Boise, you'd say, "Wow, that's a great short candidate." Is there any way to play this? If you think that a market like Idaho, is going to see a substantial housing price correction?
It's really interesting. I'm not aware of like a good way to directly do that. I think there's some indirect ways you could do it. You could look at where certain home builders and investors are concentrated that are publicly traded. That would be one way. And maybe I'm not, to be clear, I'm not suggesting this, but
Yeah.
you could theoretically buy put options on certain builders or investors that are publicly traded and have exposure to certain markets. I'm not sure if any of them are heavily exposed in Idaho, but yeah. Tennessee is another one. Tennessee, I used to live in Tennessee, still spend a lot of time there. Prices are 26% overvalued. So we have a typical price of 317,000 today. The fair value is 250 based off income levels, the actual local incomes. Georgia, prices are 27% overvalued. And if you actually just had to say what do all these states share in common except for maybe California and Washington? These were the pandemic boom states, right? These were the pandemic boom areas that everyone moved to, right? And now they're correcting, and then I think Washington, California are having their own issues because they're just so expensive, and then these markets have huge exposure to tech, and
Yep.
while maybe tech stocks are still higher than they were a year and a half ago, the hiring in tech has really slowed. So all that's now showing up in the data on these markets.
What's interesting is as much as Texas and Florida have already taken their licks, right? They were the early states to start correcting. Looks like they still have a pretty long way to go.
Yeah.
There were still some of the more overvalued states in that collection you had there.
Yeah, I think one thing, if I just can show you so people can understand it better. We calculate this overvaluation percentage going back 20 years, right? So you could see really over a long period of time if your market's over or undervalued. And if it's undervalued, like Florida was undervalued. So again, like, this isn't me trying to be bearish. This is just what the data is saying. From '09 to 2019, Florida's market was undervalued. It was a legitimately good time to buy a house. But then it started becoming overvalued in 2021, really. But then by 2023, it was 29% overvalued. Now it's down to 20% overvalued. So, you can see the correction starting to play out. Prices are dropping, incomes are edging up, but there's still a lot of downside here. And to a point you made before, this is measuring overvaluation compared to the long-term baseline. Theoretically, in a recession, it could go below the long-term baseline, right? So, that's something to pay attention to. One market I think is actually really interesting, if you don't mind me showing you a couple of specific markets here for your
Of course
viewers.
not.
Austin, Texas. Austin is like the prototypical crash market. Prices are already down 20% from peak in mid 2022. Values have dropped from 557 to 446, so a lot more affordability in Austin. But questions like, well, when's a good time to buy? Let's look at the overvaluation rate. So in 2022, Austin was 43% overvalued. Now it's 9% overvalued. So I'm going to say in the next year, Austin's market will no longer be overvalued. Its typical home value will cross to its fair home value, meaning that if you're a buyer, you're no longer getting a raw deal if you buy in Austin. So we're still probably like 6 to 12 months from that happening, but Austin's going to be one of the first markets that starts shifting into maybe undervalued territory in the next year. So that's going to be something to watch. There's some other markets that are also kind of shifting in that direction. Um, doesn't mean prices will stop dropping. It just means that on a fundamental level, it's now shifted into like, all right, you buy this house, it makes sense. That price makes sense compared to the incomes that people make in the economy.
Mhm. Nick, as I think I've been transparent with folks, I rent and have been comfortable, especially in California at this point in time, making that trade-off that it's cheaper to rent than to own right now. But I really look forward to interviewing you in a couple of years and going through this data and seeing some of the markets that my wife and I do want to buy in finally dip below, at least get to that fair value median or mean, and hopefully maybe dip below. Right now, the places we want to look, we're interested in living in are still in fairly overvalued territory. So, I think our continued strategy is going to be just to wait it out. But it's going to be fun to have these conversations with you where it's like, hey, this is an exciting place I want to live, and it actually seems like it's on sale.
Yeah, Adam, I think that's going to be really exciting over the next 1 to 2 years. It's really a matter of, and again, just to like instill into people how to understand it. If you are a buyer, right? Is my market overvalued? If so, by how much? And then what's the direction of prices the next year, right? You kind of, if you hone in on those two, you can know a lot about what the right time to buy is. So in Austin, it's now only 8% overvalued, but we still think prices are going to drop another 6 to 7% in the next year at Reventure. So you have to make a decision. You'd be like, oh, let's wait a little longer. But a year from now, say they do drop another 7%, and then the inventory starts firming up, and the price cuts start firming up. Our score will then start stabilizing, maybe shifting up a bit. Then you see that point in time, and you're like, okay, now is the time to make the purchase because I feel like this is probably the best it's going to get. So it's really those two metrics, like balancing those two metrics, overvaluation and the home price forecast.
All right. Well, and again, thanks so much for developing a tool that gives people the visibility and to be able to start making doing that calculus. So, Nick, fantastic as always. Um, for folks that have really enjoyed this discussion, really enjoy the level of detail that you and the Reventure service bring to the process here, where can folks go to follow you and where can they go to engage with the Reventure app?
Sure. So I'm very active on YouTube on my YouTube channel, Reventure Consulting. Do 2 to 3 videos a week on the housing market. Often I travel around the U.S. covering different housing markets from boots on the ground perspective. So that's a great way to stay on top of what I'm doing. But really, the biggest thing I've been focusing on the last year is developing the app because I think it has the power to provide home buyers and investors a level of knowledge that's never been attainable before in terms of helping them make a better decision. So you can access the data on the app at www.reventure.app. And we have a freemium model. So basically, some of the data points are free. Like you could look at basic home value data for free. You could see how prices have trended in the last year for free. But to get our price forecast score and the overvaluation rate all the way down to your zip code level, you'll have to upgrade to a premium plan at $39 a month. So ultimately, this is a great option for even if you're just casually looking right now, head to Reventure app and just start looking at the basic data. And then when you're ready, upgrade to that premium plan so you could see the overvalued percentage. Here we're looking at the valued percentage for where I live in Florida in Pinellas County. It's funny, you can see some markets are 53% overvalued.
Wow.
Others are undervalued. Literally, this is like 4 miles from each other,
Right.
right?
Practically next
So
door.
if you're buying a house here, you need to know these differences. We look at our price forecast. Price forecasts are a little more similar. Like in general, this market's declining, right? But hey, if your zip code's 53% overvalued, that's telling you big warning buying in this market right now, especially if it's already going down.
All right. Well, look, Nick, I will put up the links both to your excellent YouTube channel and to the app on the screen here when I edit this, folks. The links will be in the description below the video there, so you can get there with one click. Um, uh, it's always so fun having you on, Nick. And I know that maybe this is sobering to a lot of homeowners. All I'll say is, folks, this too shall pass. And I think just like my opinion with the stock market, and I do think, given the preponderance of folks that I interview, it's more likely than not going to have a rougher year ahead of it than it's had the past couple of years. But I think in many ways that's a good thing because it's starting to bring valuations back in line with fair valuations. And I just think fair valuations, whether it's in financial assets or homes, benefits the general public at large. So at least we can hopefully feel good about that, even though the path there might be a little bit painful.
And actually, on that point, Adam, I'd
Yeah.
like to show you a poll I did of my users because I was actually wondering this. I'm like you. I like renting, and ultimately, I'm using Reventure app to help me decide where and when to buy, just like my users are. Uh, but I was wondering this about like existing homeowners, like how do they feel about the prospect of home prices dropping? And I polled my audience on YouTube. And I asked them the question, what best describes your current living situation and your perspective towards home prices? And I asked, like, do you own or rent? And then do you want prices to drop or go up? So 31% of people own and want prices to drop. This was 5,200 people have voted in this poll
So
already.
interesting. And way more than those who own and want prices to go up.
Right. So almost three times as many people who own want prices to drop. 1% of people rent and want prices to go up. That's interesting. 12% of people own and want prices to go up. So at least in my audience, 86% of people, whether they're owners or renters, want prices to drop. And I think that's a pretty like representative sample for a lot of how people feel right now. I think a lot of existing owners know it's an overvalued market, and some of them feel stuck. Some of them feel like they can't actually move, right? Or if someone wants to get into real estate investing, right? Like, how do you even get into real estate investing in this market? So I think more and more there's a consensus building among Americans that they want home prices to drop, whether they're a renter or an owner. And so I think a lot of people will actually be happy with what happens over the next, 1 to 2 years in this market.
That's so interesting. And Nick, if you get a chance to give your audience a chance to clarify on why they voted the way they did, I'd love to see that data. I wonder if it's, sort of selfish, like, oh, I want to downsize and I want to be able to afford a house, even though mortgage rates are higher now, right? That's a big problem. Or selfish, like, well, if my house goes up, the assessed value is going to go up, and therefore my property
Hmm.
taxes are going to go up, and my insurance is going to go up, and all that stuff.
Yeah.
Or if it's more sort of altruistic, like I've got kids, and I feel bad that they're not going to be able to, buy a house, afford a house the way I was able to, and therefore I'd be happy to take the hit to my home value going down if it meant that they could get into a house, right?
Probably all of those.
I'm
I
sure
think
it's
it's
all of
probably
them. I'm
all of
just
those.
curious if there's
Yeah.
a preponderance, one or the other. So just wrapping up, I'm going to ask a selfish question, but I think it's applicable to probably most folks watching. So you talked earlier about the other survey that you did to your audience about why own a home, right?
Mm.
And it was basically it's a great place to raise a family and it's stability. So I'm now at a life stage where we became empty nesters this year, right? So our kids are out of the house. Um, we have enough financial stability that we're going to be okay whether we rent the rest of our lives or not, right? Um, but one of the reasons why I want to buy a house, and I think one of the real benefits of home ownership later in life, is if you can buy a house and eventually pay off the mortgage, so that you know that in your retirement years, all you got to
Mm.
cover is your property tax nut, um, and you've reduced your cost footprint dramatically, right? Which you can't do if you're renting. What are your thoughts on that?
Yeah. Makes sense, right? I mean, if especially, someone eventually is 60, 70, 80 years old down the line, right? Like you don't want to necessarily have unstable costs, right? If you're renting when you're in your 70s or 80s, your rent could go up, right?
Right.
You like the idea of having more stability. on your monthly payments, especially if you do pay off that mortgage. So I think that does make sense, right? And again, I think that feeds back to the stability notion, right? And it's also financial, right? It's
It's a
like I'm
financial
not going to have a
stability. Yeah.
huge payment. It's financial stability. I know what my payment's going to be. It's going to be lower later in life if I pay down my mortgage, pay off my mortgage. I think that does make sense. Um, I just think that the struggle in this market is that if you buy, your mortgage payment on a national basis is going to be close to 2,900 a month, inclusive of taxes and insurance and additional costs. So it's just going to be hard to get there,
Mm.
especially if you're in an expensive market like California. So I think that does make sense. But when you do the math, in a lot of markets, it just doesn't make sense, right? You do the
Right.
math on
Or
that. How
does it
long
make
would it
sense
take me
right
to
now,
pay
given
down?
their overvalued levels?
Right.
Right.
Like how long would it take to pay down my mortgage right now? Now, 2 years from now, prices drop 10%, say in California. I'm not saying they will, let's just throw that out there. Mortgage rates go from 7 to 5.8. All of a sudden, that does look like a more compelling picture, right? So it's, I think, a matter of, finding the right financial situation, the right cost structure that makes sense for pushing into that decision of buying a house in this market. And unfortunately, still in most of the US, it's not there, but it's improving and will get better over the next year.
Yeah. And back to our point about like most people are guided by whatever the dominant narrative where they are, where they live is at the moment in time. And there's so many industries, realtor industry, the banking industry, all sorts of things that try to pressure you into buying a home, that people don't see it as, hey, I can own or rent, and I can even kind of maybe bounce back and forth between the two at different points in life, right? And what's so valuable, I think, about tools like the Reventure app is they bring a whole new level of clarity into knowing what's the wise thing to do when, right? And maybe breaking the narrative of like, hey, you know what? I've owned a home, but given where things are going, house price, home price wise, and maybe where things are going in my life, maybe I'll sell while things are good. If the trends look like they're going to go down, I'll rent for a while, a couple of years, and then when things are better again, I'll get back into a house at terms that are even better, right? And maybe a little bit you could warn it's like trying to time the stock market, but as you said, housing's a little bit more predictable. It just moves a lot more slowly. Um,
Especially,
I feel like it
especially
just
if you
opens
know.
up possibilities for people who are paying attention.
Yeah, I agree. I'm glad you brought that up, especially if there's a lot of homeowners who are like feel locked in, right, on their current house.
Hmm.
And it's amazing we're seeing the inventory increase we are, even with that lock-in
Right.
effect. It's like another reason why inventory is going to increase more in the future, is because the lock-in effect will continue to ease, and even more people will put their homes on the market. But like if you're in a house you're not going to be in for the long term, which I think there's a lot of people who are in that situation, and you're in a market which is still near a peak price, but it's clearly going to drop, it does make sense to sell your house and then rent, right? Like that's not even trying to time the market. That's like, I know that I'm not going to be in this house long term that I currently own, but I can't buy a new one right now because my payment's going to go up too much. Why don't I sell, cash out the equity, and then rent and maintain my flexibility? That just sounds like a logical move if you're in a market like Florida or Texas or Tennessee or Colorado right now, and maybe even soon in California if these price declines keep occurring.
Well, I got to say, that's the thought looking out of the data that you just shared through your app put in my brain. And
Yeah.
again, maybe it may be getting easier to make those decisions now because we have tools like your app. So, anyways, fascinating. We got to wrap it up real quick. I'm realizing we didn't even talk about mortgage rates. And so somebody could, I think, correctly flame us for doing so. We don't have time to really get too into it, Nick, but I'm just curious. Mortgage rates are still pretty high right now. Um, if the administration were successful in bringing, the 10-year rate down um, without somehow causing a recession, but bringing it down materially, how would that impact your outlook, if at all?
Yeah. I think the current 30-year fixed mortgage rates around 6.97%, really has stayed in that range for the last 2.5 years. I'm not expecting a huge drop in mortgage rates. Like, I mean, there maybe on the margins it'll go down. But given current deficit levels, given The current economic environment with tariffs and inflation expectations, like it's hard for me to see mortgage rates going down. Maybe they do. Maybe they drop from 7 to 6.5 over the next year. That might put, marginally speaking, more buyers in the market to buy. But it's not going to really make a dent in the affordability situation. Just mortgage rates dropping from 7 to 6.5 or 6.4. Like I think for most buyers, that's just not going to move the needle. If I'm being honest, the people who like talking about mortgage rates are realtors and mortgage brokers.
Okay, yeah.
Because for them, like they can always think that the market's going to turn around if mortgage rates drop. But for the average buyer, the average first-time buyer, even most investors right now, they don't care about mortgage rates because the affordability is so bad, and the cap from an investor standpoint, the cap rates just don't match up to the costs that mortgage rates would really need to drop to like 5 to make some type of material impact on buyer demand in the market. So hopefully that
Okay.
answers your question.
All right. And presumably you don't see that happening anytime soon. But yeah, as you've been saying on this discussion and previous ones, it's really not, the mortgage rate isn't in the driver's seat. It's price. The price is just too damn high relative to incomes.
I'm just going to show you one more poll, if you don't mind. I know we're running along, but I polled my audience, what mortgage rate would make it worth it for you to buy a house at current prices? This was 1 month ago. 18,000 people voted. Big poll. Lots of people voted. 58% said don't care about rates, need lower prices.
Right, there's your answer right there.
34% said they would need the mortgage rate to drop to 4 for them to buy. So 92% of people who voted in this poll on my YouTube channel said don't care about rates, or they need to drop to 4%, which would be 300 basis points. Only 9%, only 2% of people said they would buy if rates dropped to 6.
Wow.
So I mean, I don't, like, you could say maybe there's some bias in this poll. I don't know. But like, I think it's a pretty good cross section of US home buyers. Uh, the mortgage rate is not driving the bus right now. It's the prices. And I think slowly but surely sellers are starting to realize that.
All right. Well, we'll have to end it there, but I guess, yeah, there's our answer right there. Okay, well, folks, look, if you've really enjoyed this discussion with Nick, please show him that and encourage him to come back on again in Q3 to give us an update on what he sees with the housing market then by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. As I mentioned earlier, for many people, their biggest financial decision they're going to make in their lives is buying or selling a house. So if you've got some questions about, real estate related decisions that you're potentially wrestling with, I highly recommend that you get help in making that decision from a good financial advisor who understands all the macro issues we talk about on this channel, but also understands all the housing issues that Nick and I just discussed here. If you've got a good one who can do that for you, great, stick with them. But if you don't, or you just like a second opinion from one who meets those criteria, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel every week. To set up one of those discussions, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill that out. And the firms will be in touch with you right away. And again, these discussions are totally free. There's no commitments involved. It's just a free public service they offer. Nick, my friend, it's been wonderful. Really look forward to seeing you on here again. And again, congrats with all the great work you're doing at Reventure. And in particular, congrats on creating such a useful app in the Reventure app.
Thank you, Adam. It was great talking to you.
All right. And everybody else, thanks so much for watching.